Hello, everyone. I'm Gayatri from Index One, and I'm joined by Chris McAfee and Craig Camille from BX. Today, we're excited to talk about alpha seeking index blends that outperform market benchmarks. So, this year, we've explored a range of index blends tailored to different investment objectives, including risk management, tax loss harvesting, and alpha generation. We examined how blending index strategies aligned with the same goal can enhance alpha potential while maintaining diversification and managing portfolio correlation. So, in today's session, we will focus on some index blends that were built using alpha seeking models developed by Libra Investment Services, Optimal Portfolio Strategies, Financial Trust, and Phaseinvest. Joining us today is Chris Sinker from Libra Investment Services, Arno Mayer from Financial Trust, and Arun Soni from Phaseinvest. We'll hear directly from these managers about their approaches to generating alpha, the mechanics behind their models, and how these strategies come together to create index blends that are specifically designed to outperform market benchmarks. We'll have time for questions after the presentation, so please submit your questions in the chat box as they come up. With that, Chris, could you walk us through the index blends that BX has created, along with the models that were selected to build them? And what was BX's approach in choosing the core strategies for these blends? And also any information on how BX thought about blending these strategies in the first place and where they would ideally fit within a broader portfolio to help drive outperformance.
Well, thanks, G. It was nice that you led in with 14 different questions that I can't remember. So
Sorry.
probably relatively limited. So thanks. So what we're generally here to do is to talk about building portfolios that deliver excess risk-adjusted returns, right? So we've talked about them in many different types of iterations. But just as a reminder, what BX is Craig and I and the team have spent years scouring the earth to find outstanding investment strategies that really aren't available on too many other platforms and in too many other ways. And so the reason we have this suite of 65 strategies out of the thousands that we've chosen is we think that each of them represents a potentially really solid building block to build a good blended portfolio. And at the end of the day, what advisors are trying to deliver to their clients is excess risk-adjusted return. So a topic that we haven't really covered in detail before is factor investing. There's a lot of reasons and tons of academic work done around factors, how you employ them, why they're important, how they can help you deliver more robust portfolios with diversification benefits. So the team, set about taking some of our different factor-driven strategies and assembling an outstanding combined portfolio out of it. So the 5 strategies that in specific we're going to talk about today are the Financial Trust Value Momentum Leaders strategy. That combines the value factor and the momentum factor. Unfortunately, Optimal Portfolio Solutions can't be with us today, but the quality factor is isolated in this sleeve. We're going to talk about Libra Investment Services, Smart Alpha, Large Cap Value Strategy. They have a number of different factor-driven models that are all outstanding in their own right. The value fit in really well with this portfolio. We're going to talk about the momentum factor, Arun Soni from Phaseinvest, and he's also going to talk about the low volatility factor. So the most typical factors that are discussed are, in fact, quality, size, value, momentum, and low volatility. The reason we didn't include a size component to this portfolio is just about everybody is already exposed to the size factor through their core investments. So we wanted to create a portfolio that was a little bit different. And one of the things that drives this particular blend, this particular strategy, is if you were to take a look at the correlation matrix between these strategies, most of the correlations are in the 60s and 70s. For an all US large cap portfolio, that's a pretty significant diversification benefit. Most typically, you'd see those numbers in a correlation matrix in the 80s or 90s, where there's really not so much of a diversification benefit. So, G, maybe we could move to the next slide. Right, so we wanted to take a look at how this particular model did versus the Russell 1000, which is a completely appropriate benchmark for this particular blend, because virtually the entire universe that's chosen from within each of these strategies are components of the Russell 1000. So it's a well-known benchmark that was totally appropriate for this portfolio. So we can go to the next slide. What's interesting there is if you look at 2022, this particular blend only was down 9.7% for the year during a year when the S&P was down closer to 19%. So that's really, that's good. That's protection when you need it most. Is when the market's down 20 and you're only down 10, that's a good place to be. And it takes much less time to get to get back to even, your time to recover, so to speak. So you can see the portfolio has delivered hundreds and hundreds of basis points in excess return over time, while at the same time minimizing the maximum drawdown, taking it from 24.5 on the Russell 1000 to 20. That's pretty significantly better, and a lower standard deviation as well. So these are the kinds of portfolios that we like to work with advisors to create, to deliver their clients the outcomes that they want, which is, at the end of the day, more return, less risk, or preferably both, which is what we've been able to do here. So what we wanted to do today that's a little different than our typical webinar is go a little deeper into some of the strategies and have you meet some of the managers. So we have a collection of about 22 different strategy creators that we've sourced from around the globe, from hundreds that we've looked at over time. And 3 of them are here with us today, and we're gonna dig into what drives their portfolio construction and their approach to isolating factors, and why it will tend to generate alpha over time. So first up, we're going to talk to Arno Mayer from Financial Trust. Arno?
Great. Hello, how's everybody doing today? Hopefully you guys are having a nice day, but wanted to go through a little bit about our firm. And G, I don't know if you want to switch to our next slide there. But Financial Trust Asset Management, I am the Chief Investment Officer, which I founded the firm in 1989. We are quantitatively oriented investment specialists. We are an SEC registered investment advisor. We are also GIPS compliant. And we've been running our investment strategies for a pretty long period of time. We have a number of different strategies available on the BX platform. Mainly the pure quantitative oriented portfolios. We run a breadth of strategies from around the world, both active, passive, and semi-passive strategies for our clients, and then other investment advisors through multiple platforms such as BX. The strategies we have on the BX platform, and we're going to really key in on just one of the strategies, but our first 2 are the American Leaders and International Leaders Index. They are our size factor strategies. Of note, our American Leaders Index through the end of last year won Top Gun Award from Informa PSN, and we were in the top 10. We won the Manager of the Decade Award, so we were in the top 10 of all U.S. equity managers, whether they were large cap, small cap, or mid cap. So we're real proud of that. Our other 2 strategies, you can go back, are the American mid cap and small cap. Those are our smart beta strategies that have 14 different factors involved in them. And the strategy we're going to talk about today is our value momentum leaders factor strategy, which we run as a purely quantitative model, but it is also the backbone of all of our active oriented strategies that incorporate additional stuff other than quantitative investment management. So G, if you can go to the next slide. So our value momentum leaders methodology really looks at US equities that have a market cap greater than $2 billion. We're looking to get into the screen initially that companies have a price to sales ratio of at least 10% lower than the average price to sales ratio on the S&P 500. We also are looking for companies that have higher year-over-year earnings, and I'll explain why we believe that is very important. And then we have our factor ranking. So once we have that initial list of securities, we're going to rank it by our proprietary combination of value and momentum, which we trademarked that name, as you guys could see. So our value metric is price to sales. And while there are multiple different value metrics out there, price to earnings, price to book, price to cash flow, we believe price to sale is probably one of the best factors because it is not easily manipulated with accounting practices like price to book or price to earnings. We combine that together with multiple momentum factors, proprietary momentum factors, and then essentially buy the top 50 stocks with the best combination of value and momentum. The portfolio is equally weighted and it is rebalanced and reallocated monthly. We believe that is very important, not just for new names coming in or names getting taken out of the portfolio, but we're going to rebalance every position back to its original target weight of 2% at the end of every month. We believe that really helps over time, especially if you have stocks that have big jumps over short periods of time, and trying to keep risk in control, which is a very big tenet of this portfolio for us. G, if you could turn to the next slide. So why value and why momentum? Well, after years in the past doing a bunch of different research on different factors, when we started our quantitative practice, over 24 years ago or so, we did a lot of studying on the different factors and found there's a unique combination of looking at value and momentum together. But we're going to isolate those two things initially and then look at how they go combined together. So there's a lot of research out there on value stocks, French FAMA, as you can see, cross-sectional expected returns of stocks. And we have at the end of this thing some of the disclosures where you could look up these different articles. The rationale for value premium is that risk premium is earned by investing in companies that might have had poor earnings prospects, but also have signal low valuation ratio. The behavioral bias essentially is resulting in mean reversion of irrational market participants. In other words, people thinking that the bad times are just going to continue on and they're anchored to that. If you can go to the next slide, G. Okay, let's look at momentum. So here's from Jadish and Titman. Returns by buying winning stocks and selling losers, implications for market efficiency. And it essentially shows investing in past winners tended to outperform past losers over the following 12-month period. The momentum factor is very well researched, as a lot of you have probably read over the years. The rationale essentially is underreaction to new information, that bias, anchoring bias that we talked about, on the value side stays in effect for some of these momentum stocks that are not reacting to all the information and maybe changing in the underlying company. And then herding as well, that can lead to long-term value revision within the individual stocks. So if you can turn to the next slide. Okay, now by combining those two factors, so Arness, Moskowitz, value momentum everywhere, showed that value momentum factors earn positive returns over various asset classes. And here's the biggest thing for us that we became aware of years ago when we started building these out, that those factors are typically negatively correlated with each other, which can significantly help with risk-adjusted returns. Also, with the momentum, one of the problems with the momentum what momentum helps with is avoiding some of the value traps. So cheap stocks can stay cheap for a long time. Momentum helps us identify stocks that are starting to be recognized by the market. May also signal the presence of a catalyst. But one of the things we tried to do with avoiding some of the issues with the value catalyst is essentially having that year-over-year earnings. So we're looking for a change to start to happen with these value stocks, and that their earnings are starting to be positive. If you can go to the next slide, please. Okay, so here, and sorry we couldn't get really updated numbers. As you can see, these numbers are through 2023, but you can see, and I'm sure Chris could probably show you some of these correlation matrix, because I think they probably have some of the updated numbers. But you can see value and momentum are negatively correlated. So that really, we believe, helps with the risk-adjusted returns within the overall model. And G, if you can go to the next slide. Finally, will these factors persist? And you can see there's an article by Beck, and it really looked at the robustness of the different strategies and implementation costs. looked across multiple different factors: low beta, size, value, momentum, liquidity, and quality, and found that value and momentum tended to be two of the more robust strategies, more robust factors out there. So we're real positive on this strategy as a part of an overall portfolio for clients that are not necessarily looking for instance, some of the big large cap names, because it's going to focus on $2 billion or greater in market cap, so it can stick both in the mid and large cap sector of the markets. And then if you go on to the next slide, G, just the disclosures. And I think if you go down, I don't know if you included them, G, but we have the where you can find those articles.
Oh, sorry, I don't think we included those references, but we can certainly send that over to our audience.
Yeah, somebody needs it, we can get them to you if you want to read the articles.
Yes. Thank you so much, Arno. Really appreciated that. Amazing. Let's move on to Phaseinvest. Arno?
Hi, everybody. How are you? I'll make it quick. I'd like to begin by talking about our portfolio construction framework, which rests on three pillars. And the first and foremost is what we believe is essential in any data analysis is cognitive error reduction. All financial data sets are dirty and messy anyway, by nature, but they contain certain cognitive biases and that are relatively easy to identify, isolate, and then mitigate. So that's one of the pillars, and this really helps in controlling some of the bias-induced negativity that can creep into portfolios. We have a short white paper on it, happy to share it. And we illustrate this through building of size portfolios, which are purely based on market cap, and they consistently outperform the underlying market purely through cognitive error reduction. Then the second pillar, which we really need, is a flexible infrastructure, both in terms of data and technology, so that we can ingest raw data, process it, clean it, create analytics out of it. And then the portfolio construction and research, technical capabilities to backtest research, as well as employing various statistical methods to build the portfolios. And finally, we believe there should be something unique, and our uniqueness is our phase detection engine. It's our innovation in stock price analysis. There's hidden information in stock prices. I mean, prices are the most rapidly moving attribute for any stock, and they can actually, if processed in a slightly more intelligent way, can yield some very interesting information that aids in building better portfolios and definitely in isolating the factor risk premium. And the outcome of the idea of these three pillars is that it helps us build portfolios that produce consistently better outcomes. Gayatri, if you could move to the second. So we have here a generic approach that we have to building factor portfolios, and it's broadly a 4-step process. So in the first stage is about defining an appropriate investment universe. We like to, in our universe, always include one share class per company. It's not that much an issue in the US, but for example, in Europe, it can be, because Scandinavia, there are multiple share classes for every company, and we do build portfolios in other regions too. But there is some uniqueness in how we build it. So for example, our one of the indices that Chris showed, the large cap momentum 10, which contains 10 stocks, is based on a universe of the largest 100 US stocks by market capitalization. The low vol index, which contains 50 stocks, is built off the top 500 US stocks by market cap. We actually build our own portfolio by using our own market cap attribute, removing multiple share classes, etc. And then another example is the dividend growth index, where we build the universe by taking companies that have grown dividends year over year over the long term. So for this particular index, you can equate it to the dividend aristocrats. We do have another dividend yield index that is built on the dividend achievers type of universe. So once the appropriate universe has been defined, what we want to do is now filter in stocks based on the factor that we want to isolate. So, for example, if we are building the momentum index, we will take its universe and filter in the top 40% of the universe based on the momentum attribute from our phase detection engine PDE model. For the low vol index, one of the attributes of the PD is also volatility. So we will select the top 50%, in this case being the 50% stocks exhibiting the lowest vol in the investment universe, but based on volatility as defined by the PDE model. And then for the dividend growth index, for example, we'll take the top 40% based on the current dividend yield. So at this point, we have exhausted the information that's contained in the attribute like low vol or dividend yield, or it could be quality or value. So in the next instance where we'll actually select the stocks to be included in the portfolio, we are done with using the attribute, but the first thing we want to do is to control the size factor. So we take the filtered universe and we segment it into 5 market cap buckets, because size is such a dominant factor that when it's really in vogue or the market's really focused on size, it will overpower the factor you're trying to isolate. And what will happen is that you think you've built a momentum or a dividend yield or a low volatility portfolio, but you've essentially taken huge size bets. So the idea is to build a portfolio that targets or isolates the factor in question, but whose median exposure on size is very much similar to the investment universe. So you're not taking a size bet. And then once we've got these size cap buckets, we rank stocks within each size bucket. So it's not selecting the top 10, but ranking them within each bucket. And then we select the targeted number of stocks, but ensuring representation from each size bucket, which means if it's 50 stocks, then 10 from each size bucket. If it's 10, then it's 2 from each size bucket. And then finally, position sizing. Equally weighted approach is a very strong approach for building portfolios, but we do believe that if there is a robust way to position size, it can really yield strong results. And so what we do is we use a smart beta weighting function in which we use the momentum signal from our PDE model as the attribute by which to affect the weighting. And the idea here is that, as we said, with stock prices, there's a lot of hidden information. And once you have filtered the universe for the attribute, for example, dividend yield, you've got stocks that have shown dividend yield growth, that have a high current dividend yield. But what you want to do is you also want to select from the filtered universe stocks that the market also recognizes are in strong trends. There's no point opposing the market. So selecting the stocks using the risk-adjusted momentum and then using the PDE momentum to position size really yields strong results, and it's a robust way of position sizing or assigning weights. And we use 60-day ADV as the liquidity constraint, so that we will never build a position that in a stock that doesn't have the ADV to justify that position. So what we try to do is hold not more than 3-4% of the ADV, and that's our approach to building factor portfolios.
Thank you so much, Arun. That was insightful. Great. And last but not least, we have Chris Tinker. Chris, do you want to take the stage?
Yes. Thank you, G. I apologise. We had a complete power failure and I lost my internet connection earlier on. So
oh no, that's fine.
All the nice things that Chris was obviously saying about me earlier, I'll have to watch on catch up. But anyway, to follow on from those two two very helpful and insightful presentations. I think there's a couple of points that I can make at the outset. What Libra does is constructs portfolios on the basis of a systematic stock valuation process. And what that means is we build stock valuations from the bottom up. I haven't got sorry, I don't have slides to present, but I can always share contacts with people afterwards if they're interested to look at white papers, or we've got quite a comprehensive coverage on our own website, which I think BX links to. So what we do is we value global companies, and the focus today is obviously on that value portfolio that Chris has featured in the BX slide there, and that's the large cap value. But the methodology spreads across all the different universes that we can focus on, and to pick up on the themes that we've been discussing so far in the webinar, we also look at underlying universes as a start point that makes sense for investors. So we are not predetermining a factor universe per se. We're saying, let's look at the large cap universe in the United States, which is essentially the S&P 500 universe, and we do this back tested historically through time. And so that 500 stock universe, we screen that universe on the basis of expected returns based on our own proprietary models. So we rank and score the entire S&P 500. And what we then do is we determine our measures of factors from the stock level. And what I mean by that is our concept of value, our concept of growth, quality, junk, etc., is a function of the metrics that we generate ourselves from the underlying data. So in this instance, rather than just treating value as a traditional academic measure, Farmer French, for example, would be looking at book to price measures. What we do is we say that a value stock is a stock which has higher than average expected returns because the implied discount rate, the cost of capital the market is currently applying to that stock, is higher than it would either be for the stock itself or across the broader market in general. So value stocks have certain characteristics, growth stocks have certain characteristics. And what that means is we see factors very much as the risk element of the decision-making part of the portfolio rather than the start point. So what we do is we look to rank all the stocks in the universe, and then we select by factor basket, factor bucket. And we look at value, we look at deep value, we look at growth, we look at quality, we look at junk, which obviously we don't invest in on a long portfolio, but we still categorize every stock by a factor basket that it exists in dynamically. So this isn't look back, this is forward looking. So we create estimates of expected return, estimates of implied future value, future payoff, and future discount rate. And so when we construct a factor portfolio, we look at our deep value components and we look at our value components of the S&P 500, and we select that universe, and that typically would be about a third of the universe would be in those two buckets. Now, within that universe, we can then rank and score the stocks where we would split equally between deep value and value portfolios. The reason for creating these differentiations between deep value and value is they actually have different characteristics themselves. A deep value stock is a stock that's basically one earnings release away from a relief recovery that it isn't as bad as you thought, and you get a recovering performance without actually any numbers coming through that are showing any material growth on future cash flows or future revenues. It's just that relief recovery where the discount rate the market starts to apply to future value starts to decline as markets think they've got sight of a turn, think they've got sight of some recovery. So they have a very different volatility shape, but they have very, very different expected return mix than those stocks that are value because we're waiting for confirmation that yes, earnings are meeting expectations and starting to come through. But value stocks in general typically have a far lower certainty factor than quality stocks or growth stocks because we don't really have confidence about long-term compounding revenues yet. We don't necessarily see value stocks as giving us transparent returns at both top line and bottom line. So our methodology uses a neural network model, which takes expectations data into it and works out what the implied expected payoff is going to be and the implied volatility is going to be for each stock. So when we construct our risk-adjusted portfolios, every stock is measured on the basis of our expected return, adjusted by implied uncertainty, implied risk. And so we rank those within the factor buckets, and we would have a 48 stock value portfolio, which would consist of 24 value stocks and 24 deep value stocks, ranked by the risk-adjusted expected returns. We rebalance every 2 months. I know that Financial Trust mentioned they rebalance every month. We rebalance every 2 months. That's our investment window where we would rebalance stocks that maybe have gone from value into being quality stocks or being from deep value into value. So we don't want to end up with a factor bias because we've held stocks. We review stocks at each rebalance, and that happens to be today, hence why I'm quite busy. But that rebalance across all our portfolios is on the third Wednesday of every other month. We do that for various reasons from a timing point of view, but what it does give us is a consistent point in time review of what we hold in these portfolios. So when they're rebalanced, it will be on closing information we've had from yesterday, so the Tuesday night close. That creates all our expected return forecasts, our rankings and our selections, and then the quality, value, deep value, growth baskets that we then generate to select from. For this value portfolio, we take the deep value and the value, as I've said, but what it does mean is that stocks that perhaps have been in a portfolio 2 months ago as deep value stocks are now becoming value stocks. So we're filling up the value bucket with some new value stocks. The stocks themselves may have just changed their factor definition slightly, but may well stay in the portfolio. But we'll have a slightly different set of risk and return outlooks from our portfolio analysis. So in sort of high level summary, what we do with our strategies is think of factors as being the risk management tool that we bring to the portfolio construction part of the process. We can analyze any of 8,000 stocks globally. We can have differentiated expectations and return forecasts over 2, 3, 6, 12, 24 months. So we have all of that information as part of our information universe to analyze. But a lot of this has come from proprietary modeling that we've done over the last 20 years. And so working with BX, what we've been able to identify is the benefit of putting these strategic stock selection products and portfolios into an environment where they can be either seen in isolation or, as Chris has highlighted here, blended with other universes where the expertise of BX in terms of matching the overall style baskets that they have end client interest in means that you can bring in these non-correlating differentiated type of processes that just reinforce the kind of work that the other groups in the BX suite of strategies can also focus. So that I'll stop at that point in terms of a general overlay, but very happy to take more specific questions or point people to things further online.
Thanks, Chris. Much appreciated. That's very insightful. I guess a question that I have for everyone on the panel today is just in current times, are you looking at a specific factor whilst creating these strategies, or are you looking at a blend of different strategies like BX is basically doing? But yeah, this is just a general question to everyone on the panel.
So do you mean how do we run some of our money individually and combining different factors together? Is that what your question is?
I guess it's like, is there a specific factor that you're currently looking at as you're building out new strategies, or are you placing importance to every factor equally?
Yeah, so no, for us, because we do our own proprietary passive and active strategies, and we have multiple different factor models, we're just blending them together, not necessarily building any other new strategies out at this point, because we run about 30 different strategies. So we cover all sorts of different avenues that are factor oriented, from the simple American Leaders Index that we had mentioned earlier, which is a size-based factor system, very simple in its approach. Simplicity can sometimes go a long way. That strategy, which I didn't mention earlier, for the last 3 years, we won the Bull Bear Masters Award through the end of the second quarter. That's based on upside downside capture ratio. And out of the US equity category, which there's 2,651 managers, it was ranked number 4. So very good risk-adjusted return on upside downside capture ratio. Then also good just peer group performance. It won the 5-star award based on 5-year performance in large cap. We were actually number 1 out of 913 strategies. Nice. So we don't change our factors around. We don't adjust the factors. I think that's probably one of the biggest differentiating ways we build our models. We don't adjust factors. Once we build the models, the factors stay the same. In the case of like American Leaders or the value momentum leaders, that strategy, we have not adjusted any of the factors, for the last 20 years. And we feel it's served us well. Now, do factors go in and out of style? Yes, absolutely, 100%. But we really believe trying to isolate what we believe are the good factors to build long-term models and then don't adjust them. We believe that's a core tenet of how we build the strategies. Value momentum leaders that we went over for the last 3 years in large cap value, we were actually ranked number 6 out of 276 strategies. So we don't do factor chasing. I think that's the biggest thing.
Nice. Thanks, Arno. And Arun and Chris, does your proprietary model say anything about what factors you should be focusing on at this time, or do you have any insights to your approaches?
I can answer quickly. No, we are not looking to select. Our focus is actually whichever factor is in question, to isolate its best capture. So if you want to build a momentum factor portfolio, then what's the best way to isolate the momentum factor? And when we say best, it means ensuring that the risk premium that's captured is largely because of momentum. Of course, you can never have it 100%, but you neutralize the effect of other factors. And then similarly, for dividend yield or volatility, will be the same, that you want those factors to be the ones that are driving the risk premium and not size or anything else. So we're looking to deliver a factor portfolio as a building block, and then as BX does, it can then be used in a blended model to deliver the US momentum effect or the US dividend yield effect. So we're not looking to say this is the time to buy momentum or this is the time to buy vol. That's up to the client, but we are providing the instrument by which to capture momentum most effectively, or dividend yield or low vol.
Awesome. Thanks, Arun. And Chris Tinker, do you have anything to add to that?
Yes, thanks. I'm afraid my internet connection's a bit low, so hopefully it looks like I'm a talking head, but you can hear me. Yeah, I would agree with both Arno and Aaron on this, that the important thing is that we construct portfolios to be essentially factor neutral, so that an investor who wants to buy value is buying what we consider to be value at this point in time. And an investor who wants to buy across a multi-asset portfolio of value, deep value, quality and growth is equally exposed to those factors. We're not taking a factor timing approach in portfolio construction, but we are allowing that to be the prerogative of the investor. To the extent that we can add layers of insight into whether we think value or deep value is making more or less of a difference. One thing that we know from the research we've done over the years is that the dynamics are dynamics of returns are not normal. They're not normally distributed, and they're not stable. In other words, what you have is a much higher degree of spread to non-linear returns amongst growth stocks and deep value stocks than you do them amongst value and quality. So these are sort of the tails of a skewed distribution, if you like. So we do get outsized returns in the tails. So we know that there's higher returns and higher volatility in certain factor baskets. But to add to Aaron's point about momentum, we have a proprietary measure of momentum, and what we consider to be a measurable and quantifiable view of momentum is not just price momentum, but we actually measure the momentum of the change in expected returns. So if expected returns are relatively stable, then the momentum is zero. In other words, the second derivative is zero. So you've got no acceleration. But when you are seeing a change in expected returns, expected payoff for a stock, you then start to get a change in market expectations, and that leads to the price momentum. And that can happen to any stock, indeed happens to every stock. So we don't treat momentum as an isolated factor. What we look at is that you can have a value stock that's got positive momentum or negative momentum as a function of what the market's changing view of its future outlook is. So we build that as a specific factor. And to the extent that all of the stock selections we have in a factor portfolio will be ranked by the expected returns, there is also an overlay that says if I've got rising positive expected returns, that's a function of the fact that I've got rising positive momentum. So we have a number of momentum filters and screens that combine to allow us to select those factor portfolios. So whilst we don't run a momentum only portfolio, any of our portfolios that are long only portfolios will have a momentum bias to the stocks we actually select. Bear in mind, if I'm putting a 48 stock portfolio together out of a universe of 500, I can screen out an awful lot of stocks with negative momentum and still have an awful lot of stocks to choose from. So the fact that we don't select by particular factors doesn't mean that we can't take a step back and take a view. We can see that there are an awful lot of quality stocks in the market right now, but not a lot of deep value stocks, for example, would be an observation that might talk to crowded trades, or it might talk to information that you could add insight to a portfolio manager who's perhaps actively managing a portfolio. But for the purpose of these strategies, where we're revisiting them every 2 months, we're realistically saying, look, these are the best value stocks we believe in this universe you can buy right now. And I think the returns that we get to these portfolios supports the fact that that process works without there necessarily being a call to bias towards a particular factor within the universe. And I think Chris and Craig and the team recognize that if people want value portfolios, they really are looking, what are the best value stocks I can buy right now, and how do I build that from a selection across different methodologies? But ultimately, the decision on what's perceived to be value is the fund management, investor, RIA, or end user's decision. So we just give you the basket you'd like to look at.
Thanks, Chris. Thanks. That's really interesting. And Chris McAfee, do you want to quickly just go through why this is all equal weighted? Is it simply because you wanted to kind of protect the diversification aspect of it, or what was the thinking around weightage?
Yeah, I think you kind of hit the nail on the head there. So what we wanted to do here was create a portfolio that gave you exposure to these different factors in roughly equal weights. There wasn't, you could run this through some sort of optimization strategy and come up with a portfolio that at the end of the day wasn't all that much different than this. So the 20% allocation to each just worked out really well in this particular case. So we kind of left it at that.
Awesome. Great. Thanks, Chris. And thank you all so much for a very elaborate and insightful conversation today. I'm just going to quickly go through, because we're kind of running out of time. I'm just going to quickly go through our role in all of this, in this entire ecosystem as Index One. So Index One is proud to serve as the index calculation provider for the BX strategies that are featured today. And it's really exciting, especially to see that these strategies are thoughtfully blended into portfolios that are aimed at driving performance while also aligning with clients' risk profiles and their broader investment goals, which is what it's all about. All the BX models that we've discussed in today's session are available on both the BX and the Index One websites. If you have a strategy that you'd like calculated in real time as an index and potentially integrated into other portfolios, please feel free to reach out to us. I guess we've done a little bit of a Q&A roundup. We don't really have any other questions coming through. So I will say at this stage, thank you everyone for your time and participation. Be sure to subscribe to our email newsletters to stay updated on our next video content. So thank you all so much for tuning in, and we look forward to seeing you next time. Thanks, everyone.